Welcome to StockTok's deep dive into Hilton Worldwide Holdings. Hilton is one of the largest global hotel operators and franchise companies in the world. At the time of recording, the stock is trading at 341, sitting just below its 52-week high of 344.75, and well above its 52-week low of 201.15. A range that tells its own story about momentum. The RSI, or Relative Strength Index, a gauge of overbought or oversold conditions, sits at 72.6, technically in overbought territory. The 50-day moving average of 309.65 and the 200-day moving average of 283.77 both trail well below current price, signaling a sustained uptrend. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Hilton Worldwide Holdings operates a capital-light, franchise-driven hospitality business, meaning the company earns fees from hotel owners who license the Hilton brand rather than owning most properties outright. That model generates recurring, relatively predictable fee income across its portfolio of brands spanning luxury, lifestyle, and select service segments globally. The StockTok score for Hilton Worldwide Holdings is 58 out of 100, translating to a hold signal. Valuation scores 10 out of 20, financial health 14 out of 20, profitability 11 out of 20, growth 15 out of 20, and smart money 8 out of 20. A mixed but not alarming profile. Now, valuation. The question every investor has to answer. Are you paying the right price? The trailing price to earnings ratio, the multiple investors are paying per dollar of current earnings, stands at 55.72 times. That is a rich multiple by any measure. The forward price to earnings ratio, based on expected earnings over the next 12 months, compresses to 37.68 times, which suggests the market is pricing in meaningful earnings growth ahead. The EV to EBITDA multiple, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, a cleaner measure of operating value, stands at 30.61 times, again, elevated relative to historical hospitality sector averages. In our view, Hilton Worldwide Holdings benefits from a durable competitive moat built on brand intangibles, a vast loyalty program generating switching costs, and a capital-light franchise model that rivals struggle to replicate at scale. The Guru Focus Value, an intrinsic value estimate based on historical multiples and growth, sits at 276.36 at the time of recording, against a market price of 341. That implies a negative margin of safety of 23.4%, meaning the stock trades at a premium to this model's estimate of fair value. Wall Street analysts, at the time of recording, have a consensus mean target of 331 across 24 analysts, with a high target of 383 and a low of 250. The next earnings report is due April 28 of 2026, with the street expecting earnings per share of approximately 1.96, ranging from 1.92 on the low end to 2.04 on the high end. A near-term catalyst worth watching. Market sentiment around Hilton Worldwide Holdings, as of the creation of this video, leans neutral, with insufficient recent news to shift the balance either way. In our view, the valuation setup warrants caution at current levels. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist assessing profitability signals, liquidity improvements, and leverage trends, comes in at 6 out of 9. That is a respectable reading, above the midpoint, suggesting the business is operationally sound on most dimensions. The Altman Z-score, a bankruptcy risk model where a score above 2.99 is considered safe, registers at 3.14 for Hilton Worldwide Holdings, clearing that threshold and indicating low near-term financial distress risk. Now, the nuances. The cash-to-debt ratio is 0.07, meaning the company holds very little cash relative to its debt load, a characteristic of capital-light, fee-based models that return cash aggressively to shareholders through buybacks. Interest coverage, the number of times operating earnings cover interest expense, stands at 4.34 times, adequate but not expansive, leaving limited cushion if earnings were to compress. The current ratio of 0.66, which measures short-term assets against short-term liabilities, is below 1, a signal typical of asset-light hospitality franchisors but worth noting. The debt-to-equity figure is negative 2.43, reflecting accumulated shareholder-friendly actions such as buybacks that have pushed book equity negative, common in this business model, but an important structural characteristic to understand. Overall, the balance sheet is functional but leveraged. The data suggests the company is managing its obligations, though headroom is not abundant. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital at 11.47%. Return on invested capital measures how effectively management deploys capital to generate returns, and the conventional benchmark for quality businesses is a consistent read above the cost of capital, generally estimated around 8 to 10% for a company of this profile. Hilton Worldwide Holdings clears that bar, in our view, though not by a dramatic margin. The gross margin is 28.2%. For context, this reflects the economics of the fee-based franchise model. Revenues include managed and franchised fees as well as owned hotel revenues, which dilute the blended margin. The operating margin, which captures profitability after overhead and operating expenses, stands at 22.37%, a healthy figure that speaks to management's cost discipline. The net margin comes in at 12.1%, a reasonable bottom-line conversion given the company's interest burden. Most importantly for long-term investors, the free cash flow margin, the percentage of revenue that converts to actual cash available after capital expenditure, is 16.15%. Free cash flow is the lifeblood of capital returns, and this reading confirms the franchise model's cash-generative character. On balance, the profitability picture is constructive, in our view, with the free cash flow margin the standout metric in this stack. On to growth. Is this business expanding? And at what rate? Over the trailing 3 years, Hilton Worldwide Holdings has delivered revenue growth of 11.1% on an annualized basis. Extending the lens to the trailing 5 years, that figure rises to 27.2% annualized, a substantially stronger reading that captures the post-pandemic demand recovery in global travel and the accelerated expansion of the company's franchise pipeline. Both figures speak to the durable demand backdrop for travel and the company's ability to grow its fee base as more hotel rooms are added to the system. What complicates the picture is the book value growth reading. Over the trailing 3 years, book value per share has declined by 78.5%, a dramatic number that demands context. This is not a sign of fundamental deterioration. Rather, it reflects the deliberate and sustained return of capital to shareholders via share repurchases, which mechanically reduces book equity. Negative book value in capital-light franchisors is a structural feature, not necessarily a flaw, but investors should understand what is driving it. The dividend yield stands at 0.18%, effectively nominal. Hilton Worldwide Holdings is not a dividend story. It is a capital appreciation and buyback story. In our view, the revenue growth trajectory is the key variable to watch, and the 5-year arc is meaningfully more impressive than the 3-year read suggests in isolation. Now let's talk smart money. What institutional capital is actually doing with this name? 13 top-tier guru investors currently hold positions in Hilton Worldwide Holdings, according to the data available at the time of recording. That is a notable number of sophisticated, high-conviction allocators with skin in the game. Among the most prominent, Bill Ackman's Pershing Square Capital Management holds the company as 5.6% of his portfolio, a meaningful weight for a concentrated fund manager of his stature, though he has marginally reduced the position by 0.06% recently. Alta Rock Partners holds the name at 3.06% of their portfolio with no change in position, suggesting steady conviction. Stephen Mandel's Lone Pine Capital has been a buyer of the stock, adding to a position that represents 0.12% of that portfolio, while Bill Nigrin of Oakmark Funds has trimmed by 9.45%, a more notable reduction worth flagging. On the broader institutional picture, only 6.8% of 13F filers, the institutional investors required to disclose holdings quarterly, are net buyers of Hilton Worldwide Holdings at the time of recording. A reading above 50% would be considered net bullish. 6.8% is decidedly below that threshold, indicating most institutional players are either holding steady or reducing exposure. Insider ownership stands at 1.39%, a low figure, suggesting management does not hold a substantial personal stake in the company's fortunes. In the most recent 3-month period, insiders recorded 0 purchases and 1 sale. The smart money picture is, in our view, mixed: a handful of high-quality holders with conviction, but weak aggregate institutional buying momentum and minimal insider alignment. And finally, the verdict. Let's bring it all together. On valuation, the data suggests Hilton Worldwide Holdings is priced for near perfection. A trailing price to earnings above 55 times and a 23% premium to Guru focuses intrinsic value estimate leave limited margin for error. On financial strength, the company sits in safe territory by the Altman Z-score model, though leverage is real, cash relative to debt is minimal, and the interest coverage ratio provides only moderate cushion. On profitability, the business earns its keep. A 16% free cash flow margin and operating margin above 22% demonstrate the quality of the franchise model's economics. On growth, the 5-year revenue trajectory is genuinely impressive, though the 3-year rate suggests some normalization as the recovery cycle matures, and book value erosion is a structural feature investors must understand. On smart money, a small number of high-conviction holders lend credibility, but aggregate institutional buying pressure is weak, insider ownership is low, and recent insider activity skews to selling. The overall setup, in our view, is one where the business quality is not in question, but the price being asked for that quality warrants caution. We'd want to see a more compelling entry point or an acceleration in earnings before becoming more constructive. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Hilton Worldwide Holdings. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.